This is your Monex Metals Market Update with Mike Maroney.
Good afternoon. It's Tuesday, September 10th, and I'm fortunate today to sit here with Bob Wiedemer, the author of Aftershock, Aftershock Investor, and soon Aftershock Investor Second Edition. I had an opportunity to sit down and meet with Bob today to discuss some of the key catalysts that affect the price of precious metals, and then I was able to sit in on a meeting that he gave for the Monex account reps to help keep them informed about the things that have a tendency to move the price of precious metals. And fortunately today, he made a wonderful presentation and talked about a new index that he's created that gives you an opportunity to understand short-term fluctuations in price in precious metals based on 5 key catalysts. And we're going to talk a little bit about that now. And Bob, you talked today about the Gold Fear Index, and everybody was extraordinarily excited about it. And you talked about the 5 key catalysts. Would you like to share that with everyone out there in video land?
Sure, Mike. Yeah, basically what we've got in the Gold Fear Index is the 5 catalysts. The first being stocks, are they moving up or down? Bonds, same. Real estate, mostly housing. The fourth would be domestic financial crises, and the fifth is foreign financial crises. What we're basically looking at is each of those 5 can either be sort of, adding to fear or reducing fear. So obviously, for example, the stock market's been on a long-term upward trend for, say, a year, your fear is going to be down. If it's starting to kind of flatten out, as it really has since May, and actually got a little more wobbly, its fear is going to be going up. Bonds, same thing. It's had a pretty nice long-term trend up until maybe, this year, and then it started to go down, and then, of course, in April, May, a lot. What we're basically saying is that although gold is really driven by fundamentals that we've talked about before, certainly money printing, fundamental financial stability, massive government debt, so forth, that's a lot of the fundamental driving gold. Also, what's a factor driving it short term is fear levels. And that's also a long-term factor as well, but it has a lot more to do with the short-term movements. So, for example, even though we're doing a lot of money printing today, it hasn't changed a lot in the last 6 months, but clearly the price of gold has. And what's driving it is whether people are more fearful of the economy or less fearful. And again, just as I was saying, whether it's stocks or bonds or real estate, if it's housing and your house price is going up, for most people, that's the biggest part of their savings, right, is their house. And if it's going up, they feel better. If it's going down, they feel a little more uncertain. Fear is up. And so when the fear goes up, basically the interest in gold goes up, fears goes down, the interest in gold goes down. And we found actually this tracks the price fairly well, certainly in the last year, to kind of basically chart the shorter term movements as opposed to those longer term fundamental drivers that I think will keep pushing gold up for quite a while.
Now, obviously, you still believe in the long-term story as far as gold is concerned, based on the money printing, based on government debt, and based on many of the things you talk about in your book. But this gives us a better short-term way to trade the market by watching these key indicators. And for example, the stock market was doing amazing between January and May, and sure enough, what we saw the gold market selling off and inevitably putting in a bottom. Do you think the stock market is the key of those 5, or probably the most prominent of those 5 catalysts?
Well, it's interesting because I think it's going to change a bit, although I think the stocks will be the one that's most important, and not so much because it's just stocks as opposed to any asset category, but many people look to the stock market as a great indicator of whether it's a good time to invest, how the economy is going. So there's a general feeling given by the stock market that I think is very, very important in terms of overall fear. I would say second, though, would be emerging markets. That's clearly that's that 5th indicator. And the fact that emerging markets have been in some financial crisis is clearly very, very important, especially since those financial crises have been in countries like India, which have, are clearly very big buyers of gold. So number 1 stock, but I'd say number 2 right now is those foreign crises, in particular emerging markets.
Now it's interesting because the entire world is printing money, and a lot of people were looking for a leading indicator to tell us when the world would finally start to change its perception about the fact that governments can continue to print with no inflation? Is what's happening in India and Brazil and these other emerging markets a key indicator that might be telling us something?
Well, I think it is, because although we have a very different economy in the U.S. from, say, India or Brazil, we share similar ills and similar sins in that there are some large current account deficits, for example, in India, just like the U.S. has. And also, yeah, they tend to print more money. Brazil prints money. The difference between us and them fundamentally is that we're given a lot more credibility. Frankly, we've earned it. I mean, the U.S. has generally managed its economy far better than those countries, and frankly, most countries in the last 200 years. And so we have a lot of credibility, so people give us a lot of leeway when we do something that frankly isn't very sound monetary policy by printing a lot of money. We're going to be able to, quote, get away with it longer than these countries. So, you know, people are going to look at India if they're printing, or Brazil and they're printing, and they're going to say, I think that's a big problem, and it's going to happen a lot quicker than the U.S. So in that sense, they're a very good leading indicator of how people, I think, will ultimately react to the type of monetary policy and type of fiscal policy that we're driving. I think these countries show it as well. And also, in another sense, they're, I think, leading indicators of what's happening in the world economy. Certainly the individual problems are causing them issues, meaning the problems they're causing in their own individual countries. But overall, some of those problems are getting kicked off by a slowing world economy. So they're a leading indicator in a couple ways.
Now, you also spoke about another key country, an emerging market, or pretty much a large economy, and that's China. What's going on in China right now, and how can they continue to print and continue to have this massive boom in construction? But what we're hearing is they're building buildings that people aren't even living in. What's happening over there?
Well, I think a lot's happening in China, and I think that is still the biggest story out there, and the most likely black swan to break that would cause a huge issue for our financial markets, and, well, a huge positive for gold. A couple of things is, one thing is that I think they are getting some inflation in China and in India. India is certainly more open about it. I think China, frankly, fakes their figures a bit more than other countries. But what's really happening there is that the government is basically forcing, you know, the banks make money off it, so force might be the right word, but they're telling their banks to lend money to build things, whether it's infrastructure, whether it's real estate. The banks are lending out a lot of money, and they're building stuff. It's just there's not really demand for it. And in fact, some of these building projects are, frankly, motivated more by government corruption. I mean, if you were to make a $500,000 or $1 million bribe off building something new, you know, you'd be a lot more likely to approve it and support it and so forth. So basically, that's what they're doing. 10 years ago, if China built something, a manufacturing plant or an office or a hotel, they used it. Now they build them and they stay empty. There was recently a mixed-use development, which was you know, offices and retail, that was 3 times the size of the Pentagon. So they're building on a massive scale, and it certainly helps create jobs for a while, but ultimately it is going to create a lot of inflation, and fundamentally it's going to show up even quicker in sort of bad debts that they'll cover by printing more money, but ultimately it blows up. And I think they're going to blow up a lot quicker than we are. In fact, they already in June had a bit of a banking crisis in China that gave us a bit of a preview of what this might look like when it finally pops.
Now, they say if the U.S. catches a cold, the rest of the world catches the flu. With China's economy at the size that it currently sits, what happens if China blows up?
Well, it's an interesting question. Are they going to give us the pneumonia or whatever? To some degree, yes. I still don't think it'll be enough to actually bring the U.S. down, but it's certainly going to be a big negative factor. As you said, their economy is huge. They import a lot from the U.S., they import a lot from everybody. So I think that we're going to find that it is one of those factors, that's why I say it's an important black swan, that could help basically precipitate more of a crisis in the U.S. I still think there'd be a fairly significant lag between when China blows and the U.S. has problems, but the two were definitely related, and China is much more of a driver certainly than it was 10 or 20 years ago.
Now, one of the variables that we've been watching is there was an arbitrage trade that was going on where people were taking delivery of COMEX gold, shipping it to Asia, converting it into kilo bars, and charging a $9 to $10 premium above the COMEX spot. And China has been buying an amazing amount of physical gold. Could it be that the general population of that country sees what's happening and they're looking at gold as one of the safer plays out there?
Oh, I think so. Given that the other play, which theoretically is safe, is Chinese banks, which basically pay no interest. They don't necessarily want to play in that stock market. Chinese stock market hasn't done particularly well. Not everybody can play in real estate. Plus, I think another driver of gold is a certain amount of that gold seems to be going through Hong Kong or Macau, and is probably playing a role in that whole corruption, which, part of, I should say, the corruption part of the Chinese economy, which is huge. And people know it, and right now they sort of overlook it simply because the economy is growing a lot. But that corruption, I think, is also what's driving a lot of gold, a lot of other purchases. And yeah, people just fearful of what's going to happen because they see it on the ground. If you're in China and you're walking through the streets, you can see the empty buildings. And you kind of sense that these buildings weren't built because there's any real need to it, but because maybe somebody got paid off, or again, because of government policy to keep people employed. And they know it's probably going to blow at some point, and they don't have a tremendous amount of long-term faith in the Chinese banking system, and for good reason. So I think that's a lot of the reason they're buying gold. And same in India. I mean, if you were holding rupees or checking account in rupees 6 months ago, now it's worth 15 to 20% less. So you'd want to have some gold.
Now here in America, we're somewhat egotistic, and I think we believe we drive the price of everything.
Right.
But when you're talking about literally billions of people suddenly wanting to own a specific commodity, that has to affect the long-term demand picture. And I know that's more of a long-term catalyst, but what do you see as far as demand that sits out on the horizon if this situation continues?
Well, I think it's huge. I use the term that's often used by stockbrokers or real estate brokers, that there's a pent-up demand. So they'll say maybe there's a pent-up demand for housing that's been building over time. I'd say the same thing's true with gold. I think there's a pent-up demand in that people are trying to be more optimistic than I think the reality is. But when it changes, when that optimism about stock market's growing 20% when the economy is growing 1 or 2%, when it changes that really makes sense, or that 85 billion in printed money is really medicine and really good for us, and it changes to recognize that it's probably not, you can have a huge rush to buy gold, not just here, but also China, in India. I mean, there are feedback effects. If China goes down, we go down, well, that's going to push China down further, right? So you get a feedback, and you get a huge demand for gold. Add to that, I don't think I completely finished answering your other question, is that there does seem to be a physical shortage showing up, and that's, we're seeing some evidence of that in what you're talking about in Asia. But I think that's also the kind of thing that could kick off a real short-term issue. We know there's a big short interest in gold. Combine that with the physical shortage. If all of that sort of works together to raise the price of gold somewhat, it could be a real virtuous spiral for gold, a vicious spiral if people are shorting it, that really shoots gold up very, very fast. Combined with, as you said, those longer-term push of China and India, I think, wanting to get gold, and ultimately the U.S., you could have some really very, very significant upward price movements when that happens.
So interestingly enough, we talked a little bit today about the amount of gold that's actually available on the COMEX, coming in at about 700,000 ounces. It was up to 3.3 million. Now it's 700,000 ounces. And we also spoke about something today where a lot of the investors that we're both talking with are telling us that they're going to buy gold, but they're waiting for some sort of event. Do you think it could be the stock market peaking and rolling over? Do you think it could be some sort of interest rate increase? Do you see anything out on the short-term horizon that could really spark this thing and make this short squeeze happen?
Yeah, I think so. I think a couple of things. One is, and that's kind of another term for my pent-up demand, money on the sidelines. People are nervous, but they're not quite ready to move, and when they see more evidence of a problem, they will move. I think the issues are going to be, number one, I think the stock market it could keep going up for a while, but I think it's going to roll over. I think you're getting to a point, which you've already seen, it's getting jittery. I think that'll be one of the catalysts, and the other is emerging markets are hardly settled. They may not be panicking right now, but they could easily have problems again. There's certainly been no fundamental fix there. So I think both of those are items I'd certainly keep a real close eye on.
Now we have China printing money, Japan printing money at an alarming rate. We're still printing $85 billion every single month, but yet somehow or another we don't see inflation yet. What is there a calculation that tells us if you print this much money worldwide, inevitably you're going to have a certain amount of inflation? Is there some mathematical equation that can give us an answer to what sits out on that horizon?
Well, in a sense, yes. What it doesn't do is it doesn't necessarily give you a mathematical calculation of the lag factor. But we reference a paper by the Federal Reserve Bank of Minneapolis, which basically went out and studied what's the correlation between increases in the money supply and increased inflation. And it's over 90%. And I do reference that paper, and I actually give part of that paper in my upcoming second edition of the Aftershock Investor. Basically says what we all knew and talked about, is certainly earlier in the 90s or 80s when we had inflation problems and we knew about it. Basically, increasing money supply causes inflation. Big surprise. And in fact, that paper references a lot of other papers, academic papers done on how increases in the money supply cause inflation, and to a correlation of over 90%. What they do say is that's a longer term correlation, but that's basically the bottom line truth. Even the Fed says it. I mean, they've said it in that paper and in many other papers that it does cause inflation. I can't give you, and that paper doesn't give you the lag factor, and that's going to change due to psychology, Mike. So part of it is what I've said before. It's inflation goes a lot quicker in, say, Argentina, where people have a little less faith in the government. I mean, you print money there, or let's say you increase the money supply 20%, you're going to get inflation of 20%, maybe even before you print. So here we're going to get a lot more positive psychology to keep inflation down, but psychology has a lot to do with how fast inflation it basically starts. Doesn't have a lot to do with whether you have it. That's basically due to the money supply. But how fast it kicks off, that's due to psychology, and that's part of what's going on here. We have a positive psychology, but that could change.
The interesting thing about investing is obviously perception is so important. A lot of people look at, let's say, the valuation of the stock market, and let's say it's at 15 trillion. Suddenly it drops $1 trillion. Where did that trillion go? It's all based on perception. Once the perception changes that the 85 billion or whatever the case may be as far as numbers is no longer a medicine and is now more of a poison, what starts to happen? What do we see? What will we notice right away once that perception changes?
Well, and it's a good point. As you say, a lot of money, where does it go when the market goes down? It goes to money heaven. That's where it goes. The value really wasn't there in the first place, and it's easy to evaporate. And right now, you're right. We're perceiving 85 billion in printed money as a plus. In fact, we get upset if we might be printing less. I mean, think back in 2005, if you're telling somebody that, hey, that stock market's going to need 85 billion in printing a month to keep it afloat. 85 billion, well, 85 times 10 is 850 billion. That's about what our money supply was back then in 2005. So we sort of know that this is, a problem. I mean, and I think that's the fundamental issue we've got here, is that people kind of in their gut, they sort of know we're creating a problem. They're just denying it. We're trying to avoid that reality now. And that will change. We saw that in the housing crisis. I mean, even though it was obvious in many cases, mortgages were going bad at an alarming rate. Many mortgages were going bad with the first payment. People wouldn't even make their first payment on some of these mortgages. We would still deny there's a problem. In 2000 or 1999, we'd see internet companies with no earnings or anything. We would deny there's any issue. But ultimately it does change, and it may not change immediately, and the government's intervention certainly helping extend that, or the distance from reality, but it doesn't do it forever. To answer your question specifically, how do we see that change? You're going to find that basically the stock market first starts to have problems like it's having. Then it starts to roll over, and you find ultimately, I think the Fed may have to come in and maybe increase money supply, increase printing. We're doing 85 billion a month, why not do 125? Creates no inflation, right? So if it creates no inflation, we'll add it. And I think the Fed will add it because they'll need to do it to keep the stock market pumped up. But that's another one of your red flags that if, we're having to do that again, that's the type of thing that says we're about ready to change that psychology. And I think this, we'll call it the QE4, might be the time that psychology starts to change much more dramatically. People go, wow, QE4? We're still having to pump up the market and still having to pump up the economy like this? And it can change rather suddenly, just as it did when the internet crisis, or I shouldn't say crisis, but the internet stock bubble popped.
Now, we spoke a couple of weeks ago and you used the term micro taper. And obviously we have a very big Federal Reserve meeting next week. Do you still believe that they could actually pull back a little bit on the string and maybe drop it down to 75 or $80 billion? Or do you think it's going to kind of stay at status quo?
Always hard to predict the Fed, but if I had to, I would say yes. I think that they're most likely to do the micro tapering, which would be about a $10 billion reduction from, say, 85 billion a month to 75 billion. The advantage of that is it doesn't really do much in terms of money printing. You're still putting a lot of money out there to help support the stock market. And the other advantage is it makes the fantasy that printing money is not a problem seem more realistic. This makes it look like we're being sensible central bankers with sensible monetary policy. We're trying to pull back the amount of money we're printing, but we're not really doing it. We're mostly talking. This is just a little bit more than talk, and I think we're still quite open to raising the amount of money we print easily next spring or summer if we need to help boost the stock market. But I think there's a real good chance for some sort of tapering. Now again, the stock market might view that as a positive. They might have expected 20 billion or more, and so a $10 billion taper might actually help the stock market for a while, but I think that's the most likely outcome is a modest tapering. You know, Fed can always surprise, but that would be my guess.
In the short term, do you think it's possible that the Federal Reserve stops quantitative easing and even tries to pull back and exit out of some of the assets on its balance sheet? Or are we looking at something that may be lasting for months and years to come?
Months and years to come. That said, well, I'll say very little chance of a pullback, of actually pulling money back out of the system. Possibility of a stop. You know, they have stopped before. They could stop again. Again, it gives you a little more credibility that you're not going to print money forever. But ultimately, no, I think we will be printing this money, and I've even said in my book, the most money will be printed as you really start entering a crisis, because then you're sort of forced to print a lot of money to stabilize the system. So I think we'll find we're printing for a long time to come. And it will be, the key is that people will become more nervous about it. Right now, people, I even ask people, why would you want to taper? In fact, one guy, I just asked him, I said, why don't we keep printing at 85 billion a month? You always keep asking me, when will the Fed stop? When will the Fed stop? And I said, you know, why would they ever need to stop? And his response to me was, well, if they stopped, if they don't stop, then the party will go on forever. Yeah. And I kind of went, what's wrong with that? Well, they kind of know what's wrong with printing money is we're going to cause problems. They just don't want to say it. And we're being very quiet about whether it's going to create inflation or there's any downsides. But we all know in our hearts it really will. And that's ultimately what's driving, again, that pent-up demand for gold. So we sort of know there's something wrong here. Just takes a little time to show it. But it's building up a huge pent-up demand.
Now, I was amazed. I sat in the audience at one of your seminars, and you asked the audience, how much money can the U.S. government borrow? And we were talking about 17 trillion, and you said, could they go to 30 trillion and 40 trillion? And it seemed as if the audience just didn't believe that they had to stop. And then you talked about, well, then why don't we do this, this, or this? What were some of the Wiedemer plans?
Sure. The Wiedemer stimulus package.
Yes.
So basically what I said is, yeah, what's the U.S. credit limit? And I give 20 trillion, 25 or 30, or no credit limit at all. And exactly, you and I are both stunned when about a third of the audience raised their hands and said there's no credit limit. And I said, well, if that's true, then I have the greatest economic package in the world. It's a Wiedemer stimulus plan. I'm going to please Democrats, Republicans. I'm going to eliminate personal income taxes, Social Security taxes, corporate income taxes, all gone. We're just going to simply borrow the money, right? Fed can buy all the bonds. Everything's great. The Wiedemer stimulus plan. No taxes. Can you imagine what that would do for the economy? If it's really true that we have no credit limit, that's what it is. And the reality is, of course, everybody in the audience recognizes, of course we have a credit limit. And of course, just simply borrowing and then having the Fed buy the money with their paper money, their printed money, just so we can maintain a stable bond market for a while and stable interest rates, it's not the solution. But it does keep it going for a longer period of time. If you are able to have the Fed buy your bonds, you're going to have a larger credit limit. That's really all it's doing. I would say we hit our credit limit in 2008 and 2009. That's when the Fed had to start QE1, and I'd say fundamentally it's because if we didn't do that, our bond market would have had a real huge problem. I'm not going to say collapse, but probably pretty darn close in 2009 if the Fed hadn't done that. So we've kind of hit our credit limit. The Federal Reserve, by buying our bonds, has simply extended our credit limit. And that's all. But it's still there.
Now, obviously, if the Federal Reserve is the only buyer of our bonds,
right.
What does that mean inevitably when they have to slow down, have to stop? Does that mean that bond prices could collapse, interest rates could skyrocket, the stock market could collapse, we could see all sorts of major problems internationally, and suddenly gold could become one of the most important assets in the world?
Well, I think what happens is that they don't stop, but that's what I'm saying later, you have to print even more because you've got these huge financial problems that you have to print money for just to keep the economy from collapsing too fast. Still collapses, but it gives you a little bit of a break. So they'll be printing even more. money in the future. I don't think they can stop. I think they'll be forced to print more. That's why I often say whether Yellen gets in or Summers gets in as chairman, doesn't matter. They're going to be printing a lot more. What does that mean if an economy that's addicted on printing money starts to have to go through withdrawal symptoms? Well, I'd say it's why you should be addicted more to gold, because that's the one thing that will do well in that situation. You know, anything that's interest rate sensitive, stocks, bonds, real estate, tends to have real problems in that situation. Gold is not interest rate sensitive and tends to do very well in situations of high fear. That's what you're really doing. And by printing even more money at that point, you're driving that demand for gold even further.
Now, you spoke today about the Federal Reserve and the fact that they're buying government bonds. And then we also spoke about why don't they try to stimulate the general economy by buying bond issued by, let's say, if they're going to build some dams in New York or build a special train that goes from Sacramento to nowhere or somewhere in California.
Right.
But you kind of really gave a great analogy that suddenly that would be a little bit different. And why did you think it would be different?
Well, it sort of shows the game, so to speak. If I say, look, I want to replace or build, replace or build most of the high schools in the U.S. and whatever junior highs costs $500 billion. I'll set up a bonding agency, the Agency for Better Schools, and then we'll go out and we'll issue the bonds. The Fed will buy them all with printed money. I'll give them the caveat, or they'll tell us that we can simply borrow the interest to pay the bonds, and that we can always roll them over, kind of like government debt. U.S. government debt, and then we just use that $500 billion to hire a lot of people, build new schools, all a positive, right? We'll have a lot of construction jobs, have better schools for everybody. It's great, all with printed money. There's nothing economically or technically wrong with it. In a sense, it's very much what the government's doing right now. Why you don't do it? It blows the cover. It really shows what the game is you're trying to do things with printed money, and it is not feasible. And people sort of go, yeah, you're right. If you can just do $500 billion in school bonds and just have the Fed buy them all with printed money and then create all these jobs, well, something's wrong with that. And it's kind of like the analogy if you're watching a crime in process, somebody's stealing money out of the back of a bank, he's sneaking into the back door and stealing money, and all of a sudden he decides, well, I'm just going to go in through the front door because it's a quicker way to get to my car and it's easier. Well, the crime hasn't changed. We're still stealing money out of the bank. What has happened is you made it much more blatant and much more obvious, and at that point it's easy to see, we got a real problem here. So you blow the game for everything if you do something like that, which, short term would create all those jobs. But long term, what it does, and even fairly short term, it basically blows the whole game and says, look, guys, you really just can't print money, have no consequences. And they know it.
Now, it really doesn't matter how they do it, because inevitably it has to take some sort of effect. And obviously, probably the most important catalyst that drives the price of gold will be inflation. And it may sit 6 months out, a year out, or whatever the case may be. But right now, we've seen gold go through a massive correction, and it looks like the stock market's getting a little peaky. A matter of fact, I think you said today that earnings would have to triple to support the prices. We've seen the 20-year bond drop from 122, 123, all the way down to 105, so that market is obviously sold off. Houses are starting to slow down because interest rates are going up. We've got issues with the emerging markets, and now we have a domestic event. Just a couple months out, we have the debt ceiling. Could that be a potential black swan?
It could be. Honestly, we've been able to get through some of these financial crises before, the domestic ones. We got through the sequester. Although the last time we had a big debt ceiling problem in 2011, well, that's when we had another big crisis. So we'll see. My guess is somehow Congress knows how important it is not to have a problem. Doesn't mean they won't. Wouldn't count on it. But we may get through that relatively easy. That said, sure to cause problems. It's sure to cause a lot of people to think, my God, we do have a $17 trillion debt. All we're really doing is just raising the ceiling. We're just saying, we're cheering because we're able to borrow more. It's just like cheering because we're printing another $85 billion rather than crying and saying, this is a huge sign of a big problem. The debt ceiling is the same thing. It's going to hit people over time that being able to raise a debt ceiling and borrow another $1.5 trillion isn't really a great thing to cheer about. So I think it could be a bit of a black swan. Depends a little bit what else happens with the rest of the economy in terms of stocks. And again, some of the emerging markets I don't think there's no problem solved there. So I think those could blow up again as well. But certainly I'd look to October as a possible event that is going to make people rethink gold.
So with all these potential catalysts, not only in the short term, but many in the long term, sitting right out there on the horizon, and with gold having pulled back from 1900 all the way back to 1200, now we're back up to about 1370. Doesn't it make sense that investors would say to themselves, it's just a matter of time before perception could change dramatically and gold could skyrocket in price? So now may be a great time to lock in gold to protect your portfolio.
Well, I think if we go 5 years in the future and you'll look back today, I think it'll be seen as a big buying opportunity, no question about it. People are going to say the fundamentals really didn't change. What happened is, well, the stock market, quite reasonably in a sense, went up due to the money printing. But we know the money printing is fundamentally not really the right way to drive up a stock market, wasn't really the right way to drive up an economy, and in fact it has huge long-term problems. That was easy to see now. I think 5 years from now we'll see this as a huge buying opportunity, and I hope people will take advantage of it.
So in other words, hindsight will be 20/20,
Exactly.
and we'll be able to look back. It's kind of like the fire's coming over the hill, and we still have an opportunity to buy insurance. It's time maybe to get on the phone, wouldn't you think?
I would think so.
Well, Bob, it's been great talking to you today. I think the information that you shared with us is absolutely fabulous. Hopefully, it's something that will help people make decisions to protect themselves and do better as we head into the future.
Thank you.
Have a great day. Now, after listening to Bob, I think everyone should give Monex a call so you can receive a free copy of Aftershock Investor. Without a doubt, one of the best books you could possibly read to prepare yourself for what sits out on the horizon. Don't wait. Give us a call. Well, thank you very much.